Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome. This is the first Markets, Mystics and Mayhem podcast for 2025. Episode 16 for those who are counting. And you know what? I'm fired up. I am really looking forward to this year. We're expecting the Kiwi economy to recover and to actually start growing at a meaningful rate into 2026. So the way we're thinking about it is, the recession that we've had ended last year, hopefully. Businesses have survived till 25 and now we're looking to thrive. So I think over the next 6 months, the rate cuts start feeding through into the economy, business confidence, improves. We start seeing more activity, growth picks up in the second half of the year. And then if we're to have this conversation, at the start of 2026, we'll be talking about growth rates of around 3% and a much better outlook. So I'm fired up and I'm optimistic, and I'm joined by Mary Jo and Sabrina, and we're going to get stuck into some of the data that's come out recently. MJ, what's happening?
I mean, I think many businesses across New Zealand have a very similar sentiment as us, because their confidence has lifted now that the Reserve Bank's, started cutting. And started delivering that policy easing, but it's that turn in activity hasn't quite started. As we say, the rate cuts, it'll take some time for that to feed through, but we're seeing some pretty good indicators that will come. It's more of a second half of 2025 kind of story, but confidence is lifting and the data is kind of indicative that we're near a turning point, because it's a bit mixed. You have some that are up, but you have some activity indicators that are still quite sluggish. So I think we are at that sort of turning point.
Yeah, and business confidence was a good survey. We got that a couple of weeks ago. What did we see?
Yeah, so we've actually got business confidence running positive for the first time in 3 years, and the highest it's been since, I think, 2017. And I think we kind of expected that based on what we've been hearing on the road, seeing in the monthly indicators. But I think what we were really looking out for was the intentions to invest and intentions to hire as well, which, they were a bit better, but they're still sort of in negative territory. And as you say, that's going to take time. But I think I like what you said, Jarrod, sort of this morning, earlier to me, sort of thing about how what we really need to see as businesses to actually start investing, and that's where that real sort of activity and that real growth comes from, which, as you say, second half of this year is what we're holding out for. But I think adding to that, we are starting to get some good news. The profitability should start to improve. It's still not running at its greatest, but I think, if you look at profitability, one of the major things that was harming businesses' profitability was high inflation and high costs, and we're starting to see inflation has been stabilised. The beast has been slayed. MJ, do you want to talk through the numbers that we saw?
Yeah, inflation, the latest print was for December quarter, and it was steady at 2.2%, which is practically at the Reserve Bank's target of 2%. So things are normalizing. We got from a high of 7.3 down to where it is now at 2.2, mostly off the back of import inflation cooling really rapidly. And we're seeing some good progress on the domestic side as well. So that's continuing to fall. It's still quite hot at 4.5% year on year. But we do see later this year, with all, our economy is still weak, the labour market is still weak, and we do expect the unemployment rate to continue rising. So all of that will put downward pressure on domestic prices. So we do see that domestic picture cooling off, which just means that overall inflation, it's job done for the Reserve Bank, that it's at 2% in that medium term. So that should just give them more confidence to continue cutting interest rates and deliver that relief.
So what are the threats? So, I'm hearing Kiwi currency's down, oil prices might bounce. We're worried about inflation picking up again. I think you said in the report that 75% of the decline in inflation is due to our imported prices coming off? What if we get a bounce back there?
Yeah, it's with that Kiwi dollar especially, it's been quite weak to start 2025, so that could add a bit of pressure coming from imported prices being a bit more expensive, particularly around petrol. So I think that's one threat. We came down because of a fall in imported inflation, but just as easily that momentum could be reversed, and we see that tradables number kind of continue and reaccelerate, which does kind of put our 2.2% inflation rate at it's a bit vulnerable to a reacceleration in the second half.
Yeah, but not unexpected, right? I mean, our forecast for the Kiwi dollar was 55, is 55. So we've been bang on the currency, and you'd already factored that into the inflation forecast for the tradables component, right? So at 55, I just want to remind viewers that if you look at some of our previous episodes, we've been saying, hey, look, the Kiwi's going to be under pressure, and we factored that into our inflation forecast, right?
Yeah, we did. So with that falling currency, it's kind of coming at a time where non-tradables will be, still falling. So yes, we could see tradables inflation pick up the pace, but that should be at a time when domestic inflation continues to cool. So it still means that we get to that 2%. So it'll still stabilize around that 2% target anyway.
Yeah, and don't forget the other part of our forecast for the Kiwi dollar, which is potentially it having actually a recovery in the second half of this year, as well as the Kiwi economy itself begins to recover, and that will help take a bit of pressure off the tradables again. So it could just be a temporary threat at the moment and not necessarily one that sticks around.
And one that the Reserve Bank will ultimately look through.
Exactly,
right?
yeah.
If it's a temporary spike, it's a temporary spike. You ignore it. So just on the Kiwi, I mean, it has fallen a lot faster than most commentators had expected. And, there's two sides to the Kiwi, right? There's the Kiwi and the dollar. So the Kiwi's soft because we've been through a recession, commodity prices, interest rate differentials, all that stuff putting weight on the Kiwi. But the real story is the strength in the dollar, right? And Trump basically coming in. So why don't you have a go at talking about the Trump trade?
Okay.
What's happened?
Throw me the hard question. Well, basically what we thought would happen in our FX tactical. So there's been quite a bit of US dollar strength off the back of Trump getting in. Markets are seeing it as quite inflationary, pro-growth and pro-business, but what does that mean? It's quite inflationary. It might mean that the Fed can't deliver as many cuts as they were maybe going to. Then you've got the tariff side, which is also inflationary. Whereas here at home, the Reserve Bank does need to be cutting hard and fast. So we've got that interest rate differential playing out quite strongly, and we've seen the Kiwi hit pretty fresh lows. But as we sort of said in the FX tactical, we might see a bit of a recovery into the sort of second half of this year as the Kiwi economy sort of starts to recover itself, and maybe as the Fed starts to catch up on rate cuts. But I think right now it's playing out how we expected it to.
Yeah, it's been a big move in a very short space of time. You've had that dollar strength with Trump coming through, Kiwi weakness with a worse recession here, and the Kiwi dollar's gone exactly to where we thought it would. And I think that weakness will actually help our economy. As a small open economy, a weaker dollar just puts the country on sale for investors and tourists. So it's going to be good for us. The weaker Kiwi right here, right now, it's a pressure relief valve for us. And then as things get better over the second half of the year, the Kiwi will strengthen again. So yeah, good call on the Kiwi.
Yeah. I mean, one other thing on that Trump trade, and I think this is something you've said before, is the primary school of thought is that it's going to be inflationary because of the tariffs. But there's that other school of thought that it's potentially deflationary, which is something you've touched on before.
Yeah. So, I mean, in the US, it could be inflationary because they're putting tariffs on a whole bunch of things, but then it depends how aggressive they are. If they're doing 10% tariffs, that's just a revenue grab And that's just the US government going, well, we'll just take a 10% clip, all right? That's not a big deal. That doesn't change consumer behavior. If they wanted to change behavior and actually divert trade, they would be putting on 30, 40, 50% tariffs. And I think we will see that on certain products, maybe like EVs, particularly if Elon has his way. So that would change behavior. And if you get that, then you might have a whole bunch of goods, like EVs that would be destined for the United States all of a sudden have to go elsewhere, and they could, wash up on our shores, at a 30% discount or something like that. Yeah. Do you know what I mean? So that we sort of watch this space. It's not just purely inflationary, but there could be some deflationary reactions.
So which camp are you on, or are we on?
I think in the US it's inflationary for sure,
Yeah.
and I think on certain products and that there'll be some inflation coming through, but I don't think Trump delivers as aggressively as what he said he would. So I'm sort of more a little bit deflationary for us, but not a lot.
I think what I was kind of trying to get you to go towards was that I think
What do you want me to say, Sabrina?
is more that ultimately our outlook is that inflation here at home could actually dip below 2%, maybe hit 1.8 even. And what does that bring about for the Reserve Bank? Well, it means more cuts. I mean, we already know more cuts are coming, but we are expecting more cuts than the Reserve Bank have indicated or signaled back in November. So what are we looking forward to this year, guys?
Yeah, we have 125 basis points of cuts already delivered by the end of last year, and then 125 more to come this year. Again, it's just what the economy needs. As you say, there's a risk that inflation potentially undershoots 2%. I mean, 1.8 wouldn't be too big of a deal. It's kind of bouncing around that 2%. And it's kind of anchored at 2%. That's not too much of a big deal, but it does, strengthen the case that they do need to deliver more than they've got in that November meeting, which is not a lot for how weak our economy currently is. We need more easing for our economy to not only just recover, but also to actually stimulate growth into 2026.
Yeah, I think it's worth reminding people that the Reserve Bank put out a OCR track, which is basically their forecast for the cash rate out over the next couple of years. And it was a bizarre track. It was really strange.
Oh, here we go.
Like you come in, you tell us you've cut 125 and then you're not too sure where you go from there. You cut to 3.5, which is their forecast. And then you're pretty much on hold for like 2 years. Whereas we're saying stop mucking about and get the cash rate to neutral, which is around 3. Get it done fast so that we can have the recovery into 2026. And, on their forecast, when they finally cut to 3%, we would actually be arguing, we might be in a position where you can start hiking again.
Yeah, the track, it's I suppose a track more fitting for the US or something where they can be on hold because their economy is still strong, their labor market is still, jobs growth there is still strong. So they have more of a case to pause, their cutting cycle. We don't have the same can't be said for us in New Zealand.
Okay, so MJ, summarize our thinking.
Yeah, I mean, 2025, it's going to be a really interesting year. I think we called it last year that it'll be a year of two halves, and it's kind of playing out where the first half is a little bit awkward. We're at a turning point where data's a bit mixed, but confidence is up. It's that second half, once those rate cuts feed through, that activity starts to rebound, and we're keeping an eye on those investment intentions and hiring intentions to see just how well this confidence is playing through to activity, because we know that that's really the source of growth. If businesses are willing to expand and hire more, that shows us not only coming out of the recession but also actually starting to grow into 2026. So that's the call for this year.
And top thoughts from you, Sabrina?
My top 4 is to subscribe and follow along to our podcast this year. It's really great to have all your support last year, and we're hoping to do bigger and better things this year. So follow along.
Nice. And that's us. We're done. Thank you. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.